Most of us think the biggest risk in investing is a market crash or maybe a recession. But what if that's completely wrong? Benjamin Graham, who's basically the father of value investing, he argued something pretty radical. He said the real battle, it's not against the market, it's against yourself. And wrapping your head around that one single idea, well, that's the key to survival.
And really, that one idea? That's the key to unlocking his entire philosophy. See, Graham looked around, and he saw that most people who lost everything, it wasn't because they were unlucky. No, it was because of predictable, emotional, human behavior. So the real danger isn't some external threat. It's about whether or not you have internal discipline.
So Graham believed that before you even think about making money, you first have to understand a crucial distinction. You have to realize there are two totally different games being played on Wall Street, and most people don't even know which one they're in.
And his distinction is, well, it's brutally clear. On one side, you've got investing. An investor, Graham said, acts like a business owner. They do the hard work, the thorough analysis, to make sure their original capital is safe and that they can get a decent return. But then, on the other side, you've got speculation. A speculator isn't thinking like a business owner. They're just betting on price movements, getting swept up in market sentiment, and totally ignoring the real value of the business underneath.
And right there, that's the trap. That's why so many people get wiped out. It's because they're playing the game of speculation, but they're telling themselves they're investing. They're chasing hot stocks, reacting to scary headlines, getting caught up in that wave of greed or fear, all while believing they're making these calm, rational, business-like decisions. It's a dangerous illusion.
Okay, so if the market is always trying to pull you into this game of speculation, how do you possibly resist that? Well, Graham came up with this brilliant mental tool to help you manage that emotional battle. He actually personified the market.
He called him Mr. Market. Now, I want you to imagine you own a piece of a business, and you have this manic business partner. That's Mr. Market. Every single day, he shows up at your door. Some days, he's just bursting with euphoria, offering to buy your shares for an absolutely insane price. But on other days, he's a complete wreck, totally panicked, and he's begging you to buy his shares for pennies on the dollar. He's literally the personification of the market's wild mood swings.
And here's the secret. You don't have to do anything he says. You can just ignore him. His emotional state, his panic, or his giddiness, it doesn't change the actual value of the business you own one bit. So his irrationality isn't a threat to you, it's an opportunity. His panic gives you a chance to buy on the cheap, and his euphoria? That's your signal to maybe sell at a great price.
And this is where you see the huge difference in behavior, right? When Mr. Market starts screaming, the speculator screams right along with him, panicking and selling low or getting greedy and buying high. But the true investor? They just ignore the noise. They've already done their homework. They have their own idea of what the business is really worth, and they use Mr. Market's moods to their advantage. Or if the prices don't make sense, they just shut the door and wait for another day.
So that whole idea, having your own valuation, your own disciplined process, it's all built on what is probably Graham's single most important concept. You could call it the ultimate defense mechanism, both against Mr. Market's craziness and maybe more importantly, against your own emotional reactions.
He called it the margin of safety. And it's a beautifully simple, powerful idea. All it means is this. You figure out what a business is really worth, its intrinsic value, and then you only buy it when the market price is significantly below that value. That gap, that discount, that's your margin of safety. It's your buffer. It's the cushion that protects you if you made a mistake in your analysis, or if some bad luck comes along, or if the market just goes completely insane for a while.
And look, this isn't just some abstract theory. Let's dig into a real-world case where Graham put this to work. And he didn't just use it to make a smart buy. He actually used it to invent a whole new way of forcing companies to do the right thing.
All right, so picture this. It's 1926. There's this company called Northern Pipeline, and its stock is trading for about $65 a share. That's the price Mr. Market is putting on it. And to almost everyone, it was just another boring, obscure company. But of course, Benjamin Graham did his homework. He started digging through the company's financial statements, and what he found was pretty astonishing. For every single share that was trading for $65, the company was holding $95 in cold hard cash and safe bonds. Think about that. It's literally like buying a wallet for 65 cents and finding 95 cents inside. That was his margin of safety, right there in black and white. Now here's the cool part. Graham didn't just quietly buy the stock and hope the market would eventually figure it out. No way. He launched one of the first ever modern shareholder activist campaigns. He fought management for 2 years to force them to give that extra cash back to the people who actually owned the company, the shareholders. See, he didn't just find the value, he went out and unlocked it.
Now, Graham's method was absolutely revolutionary, but you have to remember it was a product of its time. And as the markets changed over the decades, even his most famous student, a guy named Warren Buffett, realized that this philosophy, it had to evolve.
Yeah, Buffett himself said that just sticking rigidly to Graham's early teachings became a limitation for him. It was his legendary partner, Charlie Munger, who really pushed him to look beyond just buying things because they were statistically cheap.
And this really shows you the fundamental shift in their thinking. Graham's approach was famous for what Buffett called cigar butt investing. You know, you find a soggy old cigar butt on the street that has one good puff left in it for free. It's a fair company, but you get it at a wonderful price. But Buffett and Munger, they evolved this. They started looking for fortresses, truly wonderful, high-quality companies that you could buy at a fair price and just own for decades.
So what makes a company a fortress? What protects it? The idea is an economic moat. This is a term Buffett popularized, and it just means a sustainable competitive advantage. It could be a super powerful brand, a key patent, a network effect that's impossible to replicate. Whatever it is, it's something that keeps competitors away and lets the company earn great profits year after year. It's a shift from just looking for cheapness to looking for quality.
Okay, and this whole evolution of Graham's ideas, it brings us to the final, and maybe the most critical, and honestly, kind of unsettling lesson from his entire life's work.
Because late in his life, Graham himself said something pretty stunning. He basically admitted that the game had completely changed, with thousands of smart analysts all using the very techniques that he pioneered. Finding those simple, deeply undervalued cigar butts, it had become almost impossible. The low-hanging fruit was gone.
So that forces us to ask a really important question, right? If the master himself says that trying to outperform the market with brilliant analysis is getting way too hard, then what's the point of all this?
And that's when you see the true underlying purpose of it all. Graham's system, when you boil it all down, was never really about being the smartest guy in the room. It was about survival. It was about building a defensive process, something so disciplined and robust that it protects you from the one thing you can't come back from, making an irreversible, catastrophic mistake that takes you out of the game for good.
Because in the end, it's not about being right. It's about making sure you are never wrong in a way that takes you off the board completely. The whole point is to build a defense that guarantees you get to stay in the game, to play another day. Because the real winner isn't always the person who makes the most brilliant move, it's the person who simply survives.